Hey everybody, Marty Mazzora here, Thursday, 6th of July, 2023, after hours, with your end of week stock market snapshot. Clients, tomorrow this will come linked to an email, and this will serve as Friday's morning message. Then our weekly economic update should come to you later in the day tomorrow. If not, then over the weekend for certain. So we'll look at the S&P, as we've been doing now for weeks and weeks. We'll look at the NASDAQ 100 tracking ETF, QQQ. I want to take a look at sentiment with you today. Wrote about that this morning. I want to kind of highlight again some of the key points, and then just finish with a couple of simple breadth indicators that I think have been telling of late, or could be telling about where things are going forward. So in front of you is the daily chart of the S&P 500 index, and as you'll recall, we've been pointing out this rising wedge pattern here against long extended bearish divergence in the moving average convergence divergence, the MACD. Not a bearish divergence in the RSI, but the most overbought we've been since the market peak back in January of 2022. So we did break out of that. I thought it looked very compelling, but we bounced right off of this 43.25 resistance. I think we looked at that at the last update, and came back just marginally higher than this mid-June high. Rolled over, and really from this point to this point really are looking at some pretty notable shorter term divergences that make the setup look pretty bearish here, at least in the very short run. You can see this morning that it survived a test, or just about a test, of the 20-day moving average, which has been key on a short-term basis pretty much throughout this whole bear market as well. In fact, just zeroing in on the price, as you can see, when we had this triple topping action in here that we were paying very close attention to, then a bear flag, that we broke down below the yellow line right here, which is that 20-day moving average, and it was a pretty notable correction in here. Once we broke above it, we're able to sustain that, chopped around in here for a week or two, holding that support, and then tested it another time or two. So here we are testing it again. A breakdown below that with momentum, I think, would quickly bring us down to a test at least of the 50-day moving average. And again, further back, you can see where it lost it back in here last August, and then we established the so far bear market low. Things got bullish. We had a falling wedge, and recall we had those bullish divergences here on momentum indicators, so we got a nice pop, and we really haven't come back and tested that level as of yet. Our base case still says that it's highly likely that not only are we going to test that, believe it or not, that we actually will see lower lows before the bear market is finally over, but we think that happens amid what will turn out to be officially a recession. And there's a lot going on, and we'll talk about this morning's ADP jobs number and other data that says we're just not having it, right? You've got 3.8% unemployment, which is near a record. You've got good, solid GDP growth. Certainly doesn't sound like a recession. But again, I'm going to point to a statistic or two here in a second that will maybe suggest that nevertheless we should be continuing to look for that going forward, notwithstanding our weekly economic update, which we'll again update tomorrow. Let's take a quick look at the hourly chart. So this is a 60-day, 60-minute chart, so each candle here is an hour. Broke down out of this, call it a channel, almost a rising wedge. I want to do it like that. And then we had the setup that said, technically speaking, a breakdown was likely. Not much by way of a sell-off, and then gapped up right in here. That gap got filled today, and then bounced right along this 44.50 or so line, and then finally gave that up here this morning, pretty much on the announcement of 500,000 or so private sector payroll increases here. But as you can see, as we were, bouncing along and testing that support, which turned out to be resistance, we were really rolling over on the momentum indicators here. So on a short-term basis, it looked highly likely that this thing was going to give up the ghost. As you can see, tried to recover some today from the initial big sell-off, but still closed with a decent sell-off. The S&P was down 0.79% on the day. The NASDAQ 100 QQQ ETF, this is the hourly chart for that one, so you can see similar look. Didn't get quite above its resistance zone here like the S&P, or didn't dance above it a little bit here. Same kind of action down in here though in terms of momentum. Really, really not a good looking chart the way we view the technicals. Of course, other news, ironically, a weak jobs number, if it's not too weak tomorrow, would probably be very bullish for stocks. A strong jobs number like we had with ADP this morning would probably be resoundingly bearish for stocks. The Fed has gotten more hawkish in its tone over the last month or so. Today's ADP numbers, and I'll show you some of the internals there, was a shock to people. I think they were expecting like 220,000 new jobs. It was 496,000 or something like that. It was a lot. And a ton of it was in the leisure and hospitality space. We'll talk a little bit about that as well. So we'll see. Tomorrow's jobs number is going to be very important. Looking at the daily chart, just a really bearish looking chart. Now this, as I was pointing to right in here, looked resoundingly bearish to me against these long extended divergences and very, very overbought levels just based on the RSI. But we bounded back off of that 20-day moving average. But we are really, really rolling over here, even on the daily chart. So we've still got that very much intact sell signal on the MACD. So swing traders, short-term traders, this would have been the sell signal to break below the wedge, confirmed with the sell signal on the MACD. This would be a retest. This is where you would probably short some more. You'd have a stop a little bit above here probably. But yeah, this would be golden for the bears, meaning breakdown, retest, and a failure of the previous high amid waning momentum. Which reminds me, I'm going to back up here a second and look at unbalanced volume for the S&P as well. But we'll see. Tomorrow's data could be enough to pound this thing higher. But again, if the ADP number was any indication, and by the way, they don't always correlate that well in terms of the size of the move. Directionally, yes, but in terms of the actual number of jobs created or lost in the recession, often they differ, so it'll be interesting to see tomorrow. So backing up to the daily chart on the S&P 500, unbalanced volume basically accumulates the number of shares that trade on a given day, and they move this line in the direction of whether the day was an up day or a down day. It's an indicator that we should be very suspect of on a shorter term basis, because you could have a day where the market is up all day or just barely up and then closes down a tick, and if there was a lot of volume, it's all going to go to the downside, right? But on a longer term basis, I do think it can be telling. It certainly has been as we've charted it over the years. So you can see all the way back here to August of last year, which was kind of an interim peak. You can see we actually, you had the market rising, you had unbalanced volume kind of going up with it, right? At least right till there, and then from here to here, you had the down days were showing us more volume than the up days. And so the trend, though, has been quite notable, meaning from here we've actually achieved a new short-term high, right, and a little higher here as I showed you. But unbalanced volume really has been waning, with the exception of this area right in here. But my point here today is here we are with just a slight tick up, and man, just really rolling over on the unbalanced volume. So what that tells you is we've had almost, I think, an equal number of up days and down days. It's just that the conviction, the size of the volume, the amount of the trading was bigger on the down days than it was the up days. And, there's been some holiday, trading in here as well. So I don't want to make too much of it, but it is something that's just another, just another little box to check, or a red flag, if you will. Okay, so this morning in the written blog, I think I'll pull that over. I called it the flipping point. I don't want to suggest I mean the market's at a flipping point. I don't know that, and quite frankly, it may not be at this point. I think we'll see that moment, but I don't know that it's ready to happen just yet. But what I talked about here was with regard to sentiment, right? So the year-to-date strength of the stock market, keeping in mind that it's been a very narrow, very small number of stocks that explain the first half rally. In our view, to no small degree, that big rally in the first half can be explained by some serious broad-based bearishness heading into the year. You see, it's hard for markets to fall apart when the whole world is positioned for it for probably obvious reasons, and we've spent a lot of time on this over the past few years in terms of explaining this phenomenon. And by the way, anybody, if you didn't get that or you need some clarity on that, shoot me an email. I'd be happy to reach back out to you and kind of give you the logic behind why sentiment can be a good contrary indicator. Well, this is me cutting and pasting from this week's Investor Intelligence's advisor/newsletter sentiment survey. And the bears trimmed their number to 18.3% from 18.6%. That's the fewest bears since early January 2022. So my point up here is that the bears were growling. There was a lot of bears at the beginning of this year. Fast forward to mid-year, and there's very few. And again, in January of 2022 was as the all-time high. The market peaked, and we had pretty decent bear market last year, and one that we actually don't believe is just over just yet, or we don't think odds favor that just yet. A very low level of bears, just 15.3% in July of 2021, suggests that most professionals have already bought. That right there is a good explainer of why the sentiment can be something that you want to look at in a contrarian way. The bulls, on the other hand, rebounded to almost 55% from 50% a week ago. It's just above the 2 week ago reading of 54.3. Most bulls since 2 months before the market peaked, right? And that was at 57.2. Bull count is just below 55. The initial caution level, which says to prepare a more defensive strategy. And then the bull-bear spread, which is where I pretty much spend my time on this particular survey, expanded to a plus 36.6. That's the largest positive difference since November 2021. A difference of above 30 is the first sign of elevated risk. The wider the positive spread, the higher the risk. Now I took a snip of the chart of the bull-bear spread for advisors, and I put that red dot right at the beginning of the year. So you can see that folks were exceedingly bearish coming into the year, and they are pushing a very high bullish level right up in here, which, as the narrative I just highlighted for you says, is beginning to get a bit precarious. So the setup for the second half from just a sentiment standpoint is somewhat concerning if you're a contrarian who believes in these sentiment indicators. So here I just pointed to that January 2022 and November 2021 level. And then here I pointed to just the bulls from the beginning of the year, and then the bears, and actually today the number came out. In fact, let me pull that up for you. Here's the bulls, so you can see we got a big pop in bullishness with this week's reading, which came out today after I wrote this morning's note, and then bearishness continued to go down. So it's just basically gone from a contrarian perspective, bad to worse. So another first half ballast, certainly with regard to the economy, is or was the large consumer savings surplus heading into the year. It peaked at like 2.2 trillion last year, right? And it was still probably north of $1 trillion coming into this year. While our own index has been signaling caution, or recession, I should say, or recession risk rising since last August, here we are pushing almost a year later. The service side of the economy has held up remarkably well ever since. And the services sector ISM PMI, Purchasing Managers Index, this morning I've just confirmed that the services sector is still strong, and I'll talk about that in tomorrow's economic update. We believe that owes largely to the fact that consumer bank accounts have remained notably flush. That's that surplus, providing sufficient spending capacity and confidence when certainly compared to pre-COVID levels. Now, here's the breakdown, right? So again, think in terms of this, massive amount of surplus savings, and I'm going to show you where that is right now. And of course, that's getting spent. People bought all the stuff they're going to buy when they were locked down in COVID and got all their stimulus checks and extra unemployment. Now they're going out and having some experiences. So leisure and hospitality, 232,000 new jobs. Education and health services, 74,000. Other services, 28,000. Look at manufacturing, really mired in recession, quite frankly. Another 42,000 job loss. But construction, interesting to keep our eye on. 69,000. Natural resource and mining, something we're very bullish on long term. 69,000 new jobs. Now, here I say, well, it looks like that excess consumer savings phenomenon may be nearing its flipping point as well. So according to BCA, and the Daily Shot gives us a bunch of charts every day, they had this one up and loaded today. Household excess savings could run out as soon as September. Okay, so here's that level of savings line, is this one right here. And at the rate of spend, now that oomph that just keeps flowing into the economy that sits on consumers' bank accounts, looks like at the current trend it's about to run out. Okay. Now, when consumers spend money, it's not like it leaves the economy, right? It just shifts into someone else's bank account or someone else's pocket. The two lower rungs of the income ladder, those folks actually now have something like 5% less in their bank accounts than they did pre-COVID. So the money is moving up, and as it moves up into pockets of people who have less of a marginal propensity to spend all of their income, or to spend much of it, so to speak. And then if you get this combination where, like today, the market sold off a bit, and if that were to actually have some legs, right, and you've got this strong data that says inflation, is not going away, and the Fed has to talk tough and be tough, raising interest rates, to combat that, and then you get some weakness in the service side of the economy to kind of confirm what's going on in manufacturing. And then you have a situation where the folks who have basically pocketed these excesses, the producing class, if you will, they're very sentimental to what's going on in the asset markets, because that's where their money is. So if we get some sort of an asset sell-off, that's going to mess with the psyche of the folks who own the assets. So it's really a pretty precarious spot. On one end, we have leading indicators that look pretty weak, although the stuff right here on the surface, again, the unemployment rate and some of these other near-term data points, like the services sector PMI, are saying the economy is still plenty strong. So that doesn't give any justification for the Fed not to raise interest rates in July, and maybe like they're threatening to in September. I will throw in the caveat that the June base effects for CPI that's going to be coming out here shortly, those are pretty favorable. So we're not going to see a big, massive pop in inflation. And I know the Fed knows that, and they're talking tough anyway. So I think they're looking past that and attributing it to what it is, which is just base effects. So they're not going to really celebrate and get dovish because of a relatively soft CPI number. Because I think they fully expect that inflation is not even remotely going to get to their 2% target unless they do more. Plus, they're probably aware of the fact that the July on, pretty much through December, the base effects are not supportive. They're actually going to promote, all things equal, higher inflation prints. Now, we think that the second half of the year, as we get further into it, the economy could very well begin to weaken. So that could have some offsetting effects, and it could begin to play into Fed rhetoric. But right now, this is just a very, very interesting spot. Now, we've gotten into the weeds in the past about the options space and all the hedging and what happens leading into options expiration. So the folks we respect who spend most of their time, if not all of their time there, still tell us that there's enough going on there with some degree with hedging, some degree with this big proliferation of structured products that essentially leverage these higher interest rates to use treasuries in many cases to give some, you could go out 5 or 10 years and you could essentially guarantee that all of your money would be there just based on the fact that you're going to earn a certain interest rate on, say, a 5-year treasury bond or a zero coupon 5-year treasury bond. And then what's left over, say if somebody invests $100,000 and it takes somewhat less than that to grow to 105 years, well then what's left then can take leverage positions on the S&P 500, and they could say, listen, we guarantee you no loss on a nominal basis. Of course, you'd lose to inflation if you just have your 100,000 back. And we can give you some market gains if the market goes up over that 5-year period. So that basically gets sponsored by banks, and then those banks offload risk that they're taking onto the options market, and then when somebody sells a call, the dealer has to buy the stock, underlying stock, or some derivative of it, so that if it goes up, it protects them against losses, because if you're short a call, you lose money when the market goes up, and so on. And folks, I know I'm rambling a bit. I'm kind of getting into the weeds, and a lot of you are going to tell me you have no idea what I was talking about. Suffice to say that this dynamic is big, really, really big. And it really has been some support, along with weak sentiment going into the year up to this point. The folks who we respect, who are the experts in that space, are telling us that that's not over, that there's still probably more of that. But we're way beyond the early innings of this ball game, and we're really kind of getting compressed and piling in there and so forth. So ultimately, that sows the seeds of its own demise, and there is some historical precedent for this. But at any given time, you could have a macro event or events that actually force a flipping of that scenario, and it can really turn on its head and get very bearish in a hurry before it actually ultimately happens under its own weight. Nothing is for certain, but it appears to us that the odds of something not small to the downside are pretty significant sometime over, let's say, the next few months. But clients, as you know, the way we approach it is we don't need to know that anything's going to happen, because we can't know, or when anything's going to happen, because we can't know that either. What we need to be aware of is the risk of something like that happening in the foreseeable future. And when that risk is there, it's my blizzard analogy. You don't know if the blizzard is going to hit at that elevation where you would like to be, but if the odds are 50-50, you don't go hiking at that elevation. Doesn't mean the blizzard's going to hit. It may turn away and miss your mountain altogether. But with that kind of risk, you don't want to hike at that super high altitude. So that's kind of our message herein, is that this market may very well continue to melt higher. July looks like it could be a pretty precarious month. Those of you who read my latest on our equity market conditions index, which we just updated, that's just a once a month observation or analysis. Things that were somewhat bullish coming into June, particularly the dollar and Fed rhetoric, really flipped on their head. Our dollar technical analysis was bearish going into June, which is bullish stocks. Sure enough, it worked perfectly, at least that particular input to our index or our thesis. We're still overall bearish, but we said the dollar looks pretty compelling to help the market rally in June. That isn't there, technically speaking, for July. So July doesn't look to be as set up as nicely as June was for the market. And again, we weren't bullish going into June in terms of our long-term view of things. But I just said, hey, let's look for this. It shouldn't be surprising. So it shouldn't be surprising if we have a tough July, notwithstanding pretty good seasonality in July. We're not making a big bet one way or the other. I will say that we did buy more time in our put hedges for our core portfolio because we think the risk is greater in July, so we can get more oomph out of those if indeed we do get a good market cracking in July. But it could be that we get that, market comes back, and then we're talking a third or fourth quarter phenomenon. So a lot there to unpack, I know, and I think I'm rambling more than I usually do in this one. But the underlying theme and the message that we want to get out to you clients is that, sure, it was a really good first half if you look at the S&P. I think the Dow was up 2% or something, right? But the S&P was up in the teens. NASDAQ was up like 30-something%. You know the story. You take out 10 stocks and you got nothing, right? That's really, really, really ugly breath. The bulls will tell you that the rest of the market will catch up because there's not going to be a recession, and it's not that unusual to have weak breath. It's not like the bears all say that this weak breath hasn't been here since 99, therefore we're going to have another tech bubble bursting. We do think this weak breath is something that we should not take lightly, and we do see historical precedent that particularly if there's a recession looming, and there may not be, but that's still our base case, you better take this stuff seriously. And by the way, breadth got better and then it got worse again here in a hurry. In fact, I promised you I'd look at a couple of breadth indicators, and I'll just do that right now, and then I'll shut up. I'm seeing, a higher high on the S&P, and I'm seeing the AD line, advanced decline line, rolling over. The NASDAQ just has really ugly breath. This is not a good look here. It just looks like taking opportunities made on the up days to sell this thing, and then they're selling it in force because you have bigger volume on the down days. It's not conclusive, just another one of many, many signals that say it's a good time to do some hedging in a portfolio. Clients, like I tell you over and over again, we had a pretty nice first half of the year, and I'm telling everybody in the review meetings, don't go spending it, right? I think the second half could get really tough. We'll hedge, we'll mitigate as much of it as we can, but we still need to be in a position to make some money if indeed the market's going to continue to go higher. But we also need to be in a position not to get devastated like we didn't in COVID because we were hedged and so forth. So the trick going forward, if you will, is going to be to be in a position to mitigate some of that fall and be in a position to finally, when things ultimately play out, to be in a position to really pick up our best ideas at lower prices, because we have lots that we like during the next bull market when we think about the current regime and what we think is going to work going forward. But we just have this period right here that we've got to work through, and what I continue to do here is show you why we keep saying, thinking, and doing the things that we're doing. Folks, thank you. That was a long one. I appreciate it. I'll go in and edit it down, hopefully to palatable size. Look for the economic update either later on Friday or over the weekend. Thanks again. Take care. Bye-bye.